a degree of allegiance to AMP because I liked the philosophy or the noble purpose that AMP had. It was founded way back in the 1800s by a bunch of people who were seeking to protect each other if anything should befall them via insurance. And the noble purpose, Amicus, certus, is on the side of the building and on the side of many buildings around Australia, or the statue anyway, the sculpture anyway that relates to it, and means a sure friend in uncertain times. So that's what inspired me about AMP.
Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how and where they invest their time, their skills and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute of every day, we're investing our time, our skills, our energy and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, and sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You will hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested. Hi freedom fighters. What's your noble purpose? Do you have one? Do you even know what a noble purpose means? How often have you sat down and spent time thinking about what's your life's or your organisation or your business's noble purpose? I'd hazard a guess that it wouldn't be very often. Chances are you spend more time planning your next holiday than you do exploring your life's purpose and meaning. Yet according to a growing body of research, recognising and embracing our noble purpose is transformative in our lives and critical to our fulfilment and our level of happiness. So, do you have a noble purpose? A clear comprehension of your true calling in life and at work? Clarifying your noble purpose helps differentiate you from others and inspires you to succeed while honouring your purpose and your values every day. But what is a noble purpose? Well, according to Lisa Earle McLeod, a noble purpose is a clear and succinct statement about the impact that you and or your organisation has on others and the world at large. Lisa's research shows that noble purpose-driven leaders and players perform better, they wow customers more consistently, and they live more meaningful lives. As human beings, we're hardwired to seek meaning and purpose in our lives. And in our current world of continuous radical uncertainty, a clear purpose matters more than ever before. We all get inspired by being part of a purpose that's bigger than us. We want to be part of something that really matters, something that really makes a difference. And we're talking here about noble purpose rather than just purpose, because the word noble makes it absolutely clear. You're in the service of something bigger than yourself. And in our organisations, every single person should be in the service of adding value and improving the lives of those we serve. And the data is clear. Organisations with a noble purpose, in other words, those that focus on improving the life of others, outperform organisations that are just focused on hitting financial targets. In a blog by Chris Edmonds on the impact of purpose, he suggests that we ask everyone in our organisations what our purpose is. It's likely you'll receive some odd looks and some odd responses because it's a question that's rarely asked. And the answers you get are unlikely to inspire you. You'll hear things like, "Oh, well, the company just exists to make money," or "we sell properties," or "we broker loans," or "we print catalogues." It's no wonder that many individuals in work environments today suffer from a malaise, with many just going through the motions. Their work isn't linked to anything purposeful or meaningful beyond making money. Now, in his book Drive, Daniel Pink analyses 4 decades of human motivation science, and he concludes that humans by their nature seek purpose, a cause greater and more enduring than themselves. Creating a noble purpose leverages that natural human need and motivation. It creates a higher level thinking than that which happens with the common worldview that I'm just a cog in a wheel here. And in an article on the power of a noble purpose, Chip Bell confirms the critical role that meaningful work plays in our lives. He reinforces that human beings are hardwired for meaning. We want our lives to count for something. Unfortunately, many hard workers see work as devoid of any higher purpose. Instead, they experience work as an endless grind. But it's not the work itself that kills our spirit. It's doing work without meaning. Meaning is elevating and enriching when it reflects a valued purpose, a gallant proposition, and a virtuous promise. It inspires when it connects a person with an appealing higher plane, one that enhances, deepens, and nurtures. And this results in passion, which is released when we view our roles and responsibilities in grander terms than simply doing a task or a job. For example, people are more enthused about building a great cathedral than simply just laying bricks. It means helping every employee see a clear link between their efforts and a grander calling. And a unifying, inspiring, noble purpose helps ensure that all actions of an organisation are congruent with it. Now, the word noble is synonymous with upright, virtuous, honourable, and ethical. Terms that we don't see much of anymore in our dog-eat-dog, hyper-competitive world. We live in an era when concepts like pragmatic, cost-effective, efficient, and profitable are too often the sole criterion for decision-making. But true greatness comes from combining and integrating all of these noble attributes. So when cost-effective and conscious-effective are at odds, great leaders boldly face the conflict that comes with always standing up for purpose. As Winston Churchill famously said, "You have enemies? Good. That means you've stood up for something sometime in your life." Similarly, Gary Hamel once wrote that a noble purpose inspires sacrifice, stimulates innovation, and encourages perseverance. It allows you to endure with loyalty, patience, and persistence because you remain true to the meaning that is greater and more worthwhile than yourself. And if you really want to uncover your noble purpose, William Damon's book, Noble Purpose, The Joy of Living a Meaningful Life, is very instructive here. He reinforces that finding purpose, putting meaning into our lives, brings a sense of fulfillment. And a noble purpose takes this even further. He defines noble purpose as the intention to accomplish something both meaningful to yourself and of consequence to the world beyond yourself. He describes the personal and spiritual benefits of dedicating one's life to a cause or to many causes. And his book clearly demonstrates the benefits of purpose, providing joy in good times and resilience in adversity. And Damon concludes that leading a life of noble purpose is a true path to happiness rather than just pursuing happiness itself. And Brian Johnson from Optimize gives a great summary of the key aspects of the book Noble Purpose, which we're now going to draw on. And he agrees that this book is packed with wisdom and inspiring ideas and quotes on leading a life of purpose, a noble purpose where our ends, what we want to do with our lives, and our means, how we do it, are both noble. And the book makes it clear that we need to distinguish clearly between noble versus heroic. Often when we think of purpose or noble purpose, we tend to think of the mythical hero fighting mythical dragons, that it needs to be huge and courageous and bold and adventurous for it to qualify as an elevated noble purpose. But Damon says no. That's nice in our history books and our childhood fairy tales that are filled with courageous acts that made a difference in the world. But our noble purposes can also be historic and heroic. However, if we only define heroic as those mythologically huge events, then we're missing the point, because a noble purpose is often very mundane. A noble purpose can occur in the day-to-day. Damon says that a noble purpose can be a mother raising a child, or a doctor curing their patients. It can be a teacher educating their students to go on and make a mark in the world. These are all noble purposes, so we need to step back and see that it doesn't need to be some grand adventure, and oftentimes it's very mundane. It's often right under our nose where our most noble purpose exists. So think about your life and think about how you can give of yourself in a way that what you're doing is meaningful for you, and it's also making a contribution to your world, whether that's one child or a family or a community. This is the difference between noble purpose and heroic. So let's honour the opportunities to show up with nobility. Damon also outlines the 3 basic attributes of a noble purpose. He makes it clear that if you want to find your noble purpose, firstly, ask yourself, what skills or talents do you have? What skills are you endowed with? Secondly, what needs does the world have? Look outside of yourself and say, what does the world need from me? It's not just about, oh yeah, this is what I want to do, but what is the world asking of me? And lastly, the third thing is, what do you enjoy? So figure out what you most love to do and see where this joy meets the world's deepest need. That's your noble purpose. So what's yours? What do you most enjoy doing that most fully uses your skills, that you just have this burning need and desire to do? You feel called to do. And how does that intersect with what the world most needs from you? For me, it's waking up, educating, and helping hard-working Aussies to realise their ideal lifestyles by getting invested. And I do this at the one-to-many level through this podcast, and by hosting Realty Talk, through my books, The Freedom Formula and Get Invested, and then at the individual level, our business know-how helps you to make your ideal lifestyle happen by funding it and getting invested in property. Now, Damon's book, Noble Purpose, also includes 9 different tips on how we can cultivate our noble purpose. I'll share a couple of my favourites now because the proof is always in the pie. How do we actually cultivate our noble purpose? Well, one thing to look at are exemplars, moral exemplars. Moral exemplars are individuals who demonstrate outstanding moral conduct, often in the face of difficult or demanding circumstances. They go beyond the call of duty. Moral exemplars perform actions that go beyond what is minimal, required, ordinary, or even extraordinary. So look at people who embody the ideals that you aspire to, whether they're alive in your life right now, that you can look at and model and really inspire you. They're a moral exemplar. They're living examples, and it shows you what's possible. Or maybe it's in reading history books of people you admire. We want to look at these moral exemplars and say, look, if they can do it, I can do it. I aspire to embody these qualities more in my life and then go out and do it. Some of my noble exemplars are Gandhi, Nelson Mandela, and Mother Teresa. And closer to home, my old boss and leader extraordinaire, Paul Megas, that I was lucky enough to interview on authentic servant leadership back in episode 118 of Get Invested. So make sure you have a listen to this if you haven't already. These are all outstanding individuals who remained true to their convictions regardless of the opposition through their resilience, humility, loyalty, patience, and persistence. Another way to build your noble purpose is to immerse and surround yourself in a community of like-minded people who are engaged in the pursuit of noble purposes. The fastest way to build your noble fortitude is to join a community of people who live by high standards, who are living a noble, purposeful life. So find and spend time with people who share your values. Damon also suggests that to live a noble purpose, you need to exhibit humility, which is the quality that I admire the most but see the least in our self-focused, chest-beating, insta-everything world. He illustrates this with the Latin saying, sic transit gloria mundi, from ancient Roman times. Damon relates the story of the Roman emperor, who, at the height of his reign, was the most powerful person in the ancient world. And as the emperor is cruising in his chariot through the throngs of his adoring citizens, who are all cheering enthusiastically, the emperor is basking proudly in the light of his own godlike fame and fortune. And an advisor, who is sitting beside him, whispers quietly in his ear, sic transit gloria mundi. Sic transit gloria mundi, which means all glory is fleeting. All glory is fleeting. The emperor's advisor reminded him not to take himself so seriously, to have a deep sense of humility, which is unbelievably important if we want to cultivate a noble character and live a life of noble purpose. We need to have humility and remember that all glory is fleeting. To live a noble purpose, we need to have the humility to be able to look at what's working and what's not, and then do something about it. So just remember, sic transit gloria mundi. Now, we could all do with that advisor constantly whispering in our ear. I know I certainly could. So Damon's book makes it clear that true happiness comes about by a byproduct of the fulfillment that comes from giving yourself and your life to a noble purpose, to something bigger than yourself. As Viktor Frankl says in his famous book, Man's Search for Meaning, when you give yourself and your life to something bigger than yourself, and you don't just chase happiness, you go after something bigger than yourself and you live a life of meaning and purpose, then happiness pursues you. And happiness is a byproduct of your commitment to something bigger than your own individual happiness. As I said before, my good mother taught me that true fulfillment comes from giving freely to others without them even knowing about it and without ever expecting anything in return. So, my personal noble purpose is to leave everyone I meet smarter and smiling. And our business know-how believes in a world where everyone enjoys the time and the freedom to live with purpose, fulfillment and joy. And we do this by creating happy homes, by putting the fun back into funding. And our noble purpose cascades upwards and outwards from the individual to the collective. We start with fuss-free funding to help you secure your own happy home. And by getting invested in following your freedom formula, you enjoy happy lives. And by working with you together, we create happy giving communities where for every dollar we save, we donate a day's life-giving water to save the lives for the families in Tigray and Ethiopia who have no choice and have no voice. And in doing so together, we create happy homes for the helpless, and collectively, we create a better world. All of this revolves around our meaningful motto that people don't care how much you know until they know how much you care. So what about you? What's your noble purpose? And if you've got a noble purpose, I challenge you and your organisations to do a noble purpose check. If you brought your child or a grandchild to work for a day and allowed that child to watch you all day long, would they be able to easily discern your noble purpose solely by your actions? Because others don't watch your mouth, they watch your moves. These moves tell the real tale about whether it's a purpose you pronounce versus one that you practice. When was the last time you made a controversial decision by coming down on the side of this is the right thing to do, rather than this is the easy thing to do? And someone who embodies all of these qualities of living a noble purpose is today's very special guest, the highly acclaimed and respected Dr. Shane Oliver. As you heard in the opening snippet and intro to today's episode, Shane was attracted to join AMP as an economist way back in the early 1980s on the strength of their stated noble purpose, Amicus certus, which is Latin for a sure friend in uncertain times. And this is exactly what Dr. Shane Oliver has proved to be. Over the decades that he's remained at AMP, and he's risen to the highest ranks of their head of investment strategy and economics and their chief economist. He embodies this noble purpose, and his constant enduring loyalty, humility, patience, persistence and reliability underpin the quality of his independent, objective and transparent insights and forecasts on the global economy and its impacts on all investment asset classes. As I recently heard quoted, "Never let go of loyalty and faithfulness. Tie them around your neck and write them on your heart." And Shane demonstrates all of this and the qualities of a noble person living a noble purpose in spades. I've been listening to Shane's words of wisdom now for decades, and they've always proved to be informative, accurate, and mostly on the money. You'll struggle to find an economist and investor who adopts a consistently independent and objective view, so he's always worth listening to. And I'm very humbled and honoured to have him on the show today. Shane is one of Australia's longest-running top economic and investment experts. His extensive experience in analysing economic and investment cycles and understanding of what current positioning means by the return potential for different asset classes across shares, bonds, property and infrastructure is second to none. Shane's a regular media commentator on economic and investment market issues, and he engages regularly with investors at public events and forums. He's responsible for the provision of economic and macro investment analysis and, as part of the broader investment strategy and dynamics markets team, the management of the Dynamic Markets Fund and the determination of AMP Capital's asset allocation policy, which is applied across more than $50 billion invested in multi-asset funds. So if you're looking to understand what's happening and what's likely to happen in our uncertain world and how this affects your investments, you're really going to love today's informative discussion. And in our enlightening conversation, Shane shares how he helps to make you a better investor. He touches on the wall of worry and its impact. He gives his definition of economics, including positive versus normative economics, and its importance to your decision making. Shane breaks down the 4 types of assets. He gives his view on cryptocurrencies, which is worth a listen. And he also talks about what lies ahead in each asset class across equities and property in our post-pandemic world. We discuss why downturns are so hard to predict, and he shares the investment wisdom of Don Stammer, Jack Bogle, and other investment greats. And Shane gives you a great overview of the economic and investment movements over the last 40 years as a context for what's happening right now, what's likely to happen, and what you can and need to be doing about it. And if, like me, you enjoy Shane's insights today, make sure you follow him on Twitter on his handle @ShaneOliver, where he regularly updates you with Oliver's insights along with his weekly reports. And if you want some assistance in defining your noble purpose, grab a copy of my book, The Freedom Formula, by jumping on bushymartin.com.au/books, where I devote a couple of chapters to giving you a step-by-step process to imagine and define your why and your life vision. But before we get into this extremely informative chat, where you'll hear that there's still lots of opportunities ahead for property investors in Australia, if you want to know how to get started in property investment or how to make your property investments work a lot better, I invite you to join me on our unique live interactive Know How Property Freedom Flight program, where I'll personally guide you through my proven process for property investment success. To book your ticket or to find out more, just click on knowhowproperty.com.au/freedom fighters, or just hit the link in the show notes. And if you're looking to invest to fund your noble purpose, and you're looking for your Amicus certus to help you get there, then Shane Oliver is definitely your friend in uncertain times. As you're about to hear in this very enjoyable chat, with Dr. Shane Oliver. Welcome, freedom fighters. Now, in our current constant, connected and COVID-challenged, radically changing interdependent global world, making good decisions in all aspects of our present and our future personal and collective lives is reliant on our understanding of economics at both the macro and the micro level. But how do we make sense of the enormous dynamic complexity and the deluge of often conflicting information that we're drowning in every single day? Well, in my view, it's by embracing the insights and wisdom of an independent and objective economist who's both lived, breathed and observed decades of economic, political and investment cycles. And today, we're joined by what I consider to be the best in the business. And he doesn't know it yet, but he's another one of my long-term virtual mentors, Dr. Shane Oliver. So welcome and let's get invested, Shane.
Thank you, Bushy. It's a pleasure to be here.
Shane, you'd have to be living under a rock not to know who you are, given the longevity of time you've spent in the industry. But for those who haven't, who are you, what do you do, and why do you do what you do, Shane?
There's a lot in that. I'm the Chief Economist and Head of Investment Strategy at AMP Capital, which is the investing arm of AMP. I guess when you're in school, you don't have a strong idea of what you want to do, but I fell in love with economics when I was in the final years of school. That led me to study economics at university, and I initially thought I don't want to be involved in financial economics, so I did everything I possibly could to avoid financial economics. But as it turned out, this was the late 70s, early 80s, and of course that was a time of significant financial reform as we went into the 1980s. And so inevitably I seemed to get sucked into financial economics. And I was fortunate enough, back in those days, big employers would come to universities and you'd have these careers days and what have you. And so I met someone from AMP at the time and ultimately ended up working there. And I've been there all my career, so this starts back in 1984. And somewhere along the way, I also diverted into doing a PhD in economics, which was focused on, well, the title of it was Theory of Speculation in Asset Markets. These days, you might have a title which has perhaps more to do with speculative bubbles or behavioural finance, but back in those days, they weren't called speculative bubbles and there wasn't behavioural finance as a topic. But in any case, I guess I formed a degree of allegiance to AMP because I liked the philosophy or the noble purpose that AMP had. It was founded way back in the 1800s by a bunch of people who were seeking to protect each other if anything should befall them via insurance. And the noble purpose, Amicus, certus, is on the side of the building and on the side of many buildings around Australia, or the statue anyway, the sculpture anyway that relates to it, and means a sure friend in uncertain times. So that's what inspired me about AMP. Obviously, some listeners may question that given what happened at the Royal Commission and so on, but it's something that I thought was a good purpose for AMP, and by and large it fulfilled that. But obviously there has been some issues in recent times, which I won't go into here. But in any case, one of the things that kept me at AMP was that they gave me it was a day a week to study to complete my PhD. So that took another 8 years by the time I finished the thing. And so this took us into the early 90s recession. I did receive various other job offers at the time, but thought, well, I've been given this opportunity to finish my PhD, I should stay with AMP, and of course I've been there ever since. But the thing that I love about economics and investing, or my job, the job that I've had, is that it combines a whole bunch of different things. It combines a love of economics. It combines, I guess, a sensible long-term approach to investing, and it puts that all together with an ability to go and talk to people, which I think are all immensely positive. It means I don't just have to sit at my desk all day. It means I get to see ordinary people, or at least I did prior to coronavirus. These days it's a bit more limited, except via this sort of means, via technology. Yeah. But it's meant a varied and exciting sort of job And I've often thought that, I've got the best job in a financial organisation because it had all those three things combined. So that's who I am. That's what I've been doing. And hopefully over the years I've been able to help make people better investors. I won't, of course, claim to have converted everybody to my approaches, but at least hopefully I've helped some people along the way stay the course through difficult times. I guess one other thing I should note in all of this is that gloomy economists are a dime a dozen. In fact, the old term for the economics is the dismal science. That probably goes back to an economist called Thomas Malthus, who said many, many centuries ago that the basic economic problem is that there's unlimited demands with limited resources, and eventually, we'll all starve or something because there won't be enough of us, won't be enough food to feed us. And of course, that led to economics becoming known as the dismal science. As it's turned out, those sort of predictions have been made regularly over the years. The Club of Rome in the early 70s, more recently with talk about peak oil and how we're going to be ruined when we run out of oil and run out of this or that. And of course, the world seems to move on as technology solves the problem and something better comes along and we don't run out. But I think it's the same with economics more broadly, that it's quite easy to look out there and see everything in a gloomy fashion. In fact, I'm looking out my window now and all I see is cool weather. I'm in a relatively temperate part of Australia, but it's still pretty cold. And clouds, and coronavirus is running right again in where I live in Sydney. So it seems pretty gloomy. And at any point in time, it's easy to come up with lots of reasons to be gloomy, but history tells us that investment markets climb a so-called wall of worry and pull out of that. So I think there's a little bit of a market in there to sort of try and put a bit of balance on things and say, yeah, things might be a bit tough now, but just bear in mind we normally pull out of this and things often aren't as bad as you think they are. So I usually try and take a more balanced, longer-term historical perspective, which usually sees things as turning out okay.
Spot on, and I've got to say personally, Shane, that having been following your insights for, it's got to be at least 30 years now, it's really put me in a very good position to make some good quality decisions that have had some very positive outcomes for us in the investment sphere. So I haven't had a chance to personally thank you. I've just publicly done it now. But
thanks for that. That's great to hear.
But Shane, I just want to circle back a little bit on the great summary you've just given us on your journey so far, and delve into the great subject of economics, because when you said that in your the final years of high school you this love and attraction to economics emerged. It's not something that most Aussies get excited about when you talk about economics. What was it that sort of lit up for you?
Look, it was a bunch of things. I think I had a good teacher at the time. There's a guy called Mick O'Rourke, who was an economics teacher. That was in year 11 in New South Wales. The second last year is year 11 and year 12 is the final year. Yeah. And there's another guy called Mr. Tracy in year 12. But both of them inspired me. But I think more broadly, you can see that all this stuff going on around you. Obviously, there's the stuff which you can take back to science, biology, chemistry, physics, and so on. And then there's this other stuff, which is economic life that people lead, the decisions they make in terms of buying and selling things, and how they feed their family and holidays and the choices they make, number of kids they have. And you can apply economics to virtually all of those things. Economics in many ways has become more narrowly focused as relating to things relating to money. But the basic economic problem can really be related to happiness. To me, I think it is the ultimate science of happiness. It's designed to maximise. It's about satisfying, maximising people's happiness as far as possible. Satisfying is sort of a second best way of achieving that. But now, of course, the problem economists always face is that they can't measure actual happiness. You can do surveys and so on, but they can be a bit dodgy. You ask a heroin addict what makes them happy, they'll say another fix. a hit of heroin, which is probably not the best thing you want to do. So surveys can often be flawed in terms of measuring people's happiness. But anyway, economists said, "Oh well, okay, we don't know the answer to that. Let's assume that people get happy when they get more consumption goods, when they consume more." And so consequently, a lot of economics has been about maximising consumption, which of course has meant that it's become very narrowly focused. But ultimately, it is about happiness. And that, I think, is quite profound and gives you insights about all sorts of things that we do through our lives. So that's what I like about economics. And plus the fact that it does provide a discipline. If I'm thinking about coronavirus, whether to have a lockdown or not, if I'm thinking about interest rates, if I'm thinking about inflation, if I'm thinking about unemployment, if I'm thinking about housing, there's insights that economics can provide in relation to all of those things, and it just provides a disciplined way of thinking, which sometimes is why economists annoy people, because they tend to be disciplined. They often tend to be objective. I think I probably don't go that well on Twitter, because Twitter seems anyway to be designed to have a rant. People are on there for a rant, and
right.
And I'm on there trying to not rant, but just analyse why things are. But of course, so many of those on Twitter think that if I'm saying the property market is going up, and that's just an observation based on what's happening, they will think that I'm saying that's a good thing, whereas I'm not saying any such thing. I'm just saying this is what's happening. But unfortunately, in the Twitter sphere, it's often hard for people to just differentiate between what you might call positive economics, which is just the analysis of what is and why, versus normative economics, which is what should be, which is radically different. But anyway, in any case, I think it's the fact that economics can be applied to so many things that is what I love about it.
Yeah, it's a great framework for making decisions individually and collectively from where I sit it, because you've got a basis upon which to start making those judgment calls. But I'm just interested in something you just mentioned there, because I think you make a very good point that ultimately economics is about measuring happiness, and as you well said, it's impossible to actually measure happiness. I think we're again looking from the outside in. I see a lot of economists try to quantify to justify almost, but the measures that they use are often so isolated from how we think and behave that it can limit the usefulness of some of those insights. What's your read around that? And I guess I'm talking here the difference between the sort of classical economics and the more behavioural science that started to come through over the last 10 years or so. What's your view around that?
I think that's a valid point. My take on it is that when economics or economists were, the discipline was in its formative years, that they didn't have much ability to model the way people actually think. And so they had to use these simplifying assumptions, which today look very flawed. And as a consequence, it's been quite easy to criticise economists. I mean, the classic one is several people on an island, and they've got a can opener without a can. It's a deserted island, and washed ashore, and they've got a can opener without a can. And of course, the people of other disciplines come with all sorts of ideas, but the economist says, well, let's assume we have a can opener. So it can often seem to be rather remote and unrelating to what people are actually doing. But nevertheless, there's still some value in it. If you take investing, there is a basic thesis or theorem called the efficient market hypothesis, which assumes that all information that relates to a particular stock or a property market or the share market generally is rationally reflected in current prices. And therefore, it's impossible for an investor to make supernormal profits. You can't buy Qantas shares today and expect to earn more than you'll get from the overall market. And that theory sort of underpin much of economic thinking with regards to investing. It's called the efficient markets hypothesis, and it basically says there's no supernormal return. But it also says that investment markets are always rational. And Milton Friedman, who was an economist, said, well, we know they're not always rational, but we can assume they are because speculators will act rationally over time. They will, to make money, a speculator might buy things when they're cheap and sell them when they're expensive, and vice versa, sell them when they're expensive and buy them when they're cheap. So that will act to bring in share prices or property prices back to some sort of equilibrium, which should be in line with efficient markets. So I think economists always knew that markets can sometimes go off the rails, but they assumed that they would behave fairly close to what you might regard as rational. Now, the problem is that as the years went by, it was quite clear that that wasn't always the case. We had the 1987 share market crash, which in my mind was a bit like an epiphany, because it was something I lived through and was conscious of. One day the market was X, and 2 days later it was 35% lower, and 2 months later it was 50% lower. It's impossible to say that back in August, September 1987, that was a rational level for the share market, but it was also rational a couple of months later when it was 50% lower. The only way you can explain that is that something irrational occurred. And since that time, since the 1980s, there's been an explosion in behavioural economics, which I think has led to massive insights. I mean, I have to admit that the work actually started before that. Kahneman and Tversky probably wrote the first notable article on the fact that people behave differently to the rational man or the rational woman would. But that's led to a lot of insights, and particularly in relation to investing. And the funny thing is, I think that a lot of economists always knew this. In the back of my mind, if you think about Keynes, well-known economist, John Maynard Keynes, but he's reported to have made a lot of money in the share market trading, and he would have been doing that on the basis that he once said, the trick is not to work out where something should be, it's to work out what the average person thinks it should be at. He called it a beauty contest. You're not actually judging which person is the most beautiful. You're judging the one that the market will think is the most beautiful. So there's a degree of behavioural analysis embedded in that. But I think it's nice the way it's come together in recent times, that psychology and economics have sort of come together, and insights from psychology are feeding into economics. Whereas back in the 1980s, early 80s, when I was doing my PhD, that seemed more like a novelty. These days it's taken for granted. But I think it has enriched economics tremendously, and therefore it's made it a lot more insightful.
Totally agree. And I think again, I'm not an economist, but I like to observe from the outside. I sense that we've sort of grown through a world where no one takes it seriously unless you can treat something like a science. But and while there are scientific aspects to economics, I would treat economics more as an art form, because again, I've made this quote before. There's a spectrum between making clouds and making clocks. And
that's right.
When we try and treat a cloud like a clock, that's when we get into strife. And because of this predominant thinking that when you're establishing a discipline, you've got to make it as scientific as possible to be able to be taken seriously by the academia at large, there's a danger that you oversimplify a very complex and dynamic system, which is economics about, and therefore can constrain and limit to some degree the usefulness of some of the forecasting tools that have to try and quantify. What's your read on that, Shane?
Well, that's about right. And unfortunately, I think economics became very scientific as we went into the 70s and 80s. A lot of the economics journals became almost like mathematical journals, indecipherable to the average person, whereas the economics of, say, a Friedman in the 50s and 60s, or Keynes in the general theory, which came out in the 1930s, is a lot more accessible. It's written in a funny way, but it is a lot more accessible. So, economics seemed to go off the rails a little bit. It became too scientific for its own good, and then seemed to have pulled back in recent times. I mean, you have to, as far as possible, it is useful to be as scientific as possible. If you're trying to analyse the property market, it's useful to have some data there.
Yeah.
If you get, for example, every Saturday night we get clearance rates for Sydney and Melbourne and the other cities, but the numbers aren't as significant in the other cities. There's not enough in there, I think, to read too much into them. But we do get that data. But I think on its own, it's next to useless. Yeah. You've got to have some sort of context in which to see it, and therefore I like to tweet a little graph which shows relative whether it's higher or not relative to its history. Yep. So there's an element of science in that, but by the same token, I don't want to exaggerate it because it's not a perfect system. I love this saying that if you think about chaotic systems, the weather is a level 1 chaotic system, whereas much of economics is a level 2 chaotic system. So whatever the weather forecasting people say about the weather, it has no impact on the weather. But what commentators and economists and others say about the economy does have an impact on the economy. So you've got two levels there, what it's going to do and then what the commentators do and then how people react to that. So, which then adds another degree of complexity to it. Take last year, for example, going into the coronavirus setback, you can make all sorts of predictions that we're going to have a recession and the recession would be bad for property markets, say, and unemployment will go up, and historically it's taken this long to get out of it. But then, of course, policymakers saw those forecasts and then reacted in a way which made it such that things were not as bad as the original forecast would suggest. So it sort of takes on a life of its own over and above what would happen if you didn't intervene in there. So that's why it's a level 2 chaotic system. But it does mean that you want to be scientific, you want to have some evidence to say what you're going to say, but you also have to allow that there's a bit of art in all of this. I think economics is a big mix of science. There's a bit of science in there. You want to try and scientifically measure things if you can, but there's also a massive amount of art in there where you've got to apply some judgment.
Yeah, I totally agree. Shane, in sort of putting some context around, before we start talking around what's happening at the macro and the micro level in the economy, both now and moving forward, I'd love for you to share your experience of economic waves, right back from the time you started studying economics, because I think it sets a bit of a framework for a discussion around what's happening now and what we need to be doing about it. But it also, I'd love for you to expand on the economic cycles, but also talk to us a bit about how did that influence your own journey in terms of what you were investing in personally and why. Can you sort of take us on that journey for a minute?
Yeah, sure. Look, I guess the first cyclical downturn that I was conscious of was in the 1970s, say 73, 74, and the recessions around that time. And I remember relatives, my aunt saying, things must be really bad, complaining that business had gone on strike because there's no investment. The share market at that time in Australia fell 59% from a high in January 73 to a low in September, October 74. I sometimes relate it to my favourite TV show, The Brady Bunch, being canned in 74. So Brady Bunch started in 69 and ran through 74 and then got canned, along with Partridge Family.
Yes, I remember both of those very well, mate. We're a similar age.
So that would have been depressing for me back then. And I sort of joke, I got so depressed and I sold all my shares. But there were horrible things happening in the economy. Property companies going bust, and that one, I guess, I was only in my teens then, so it didn't directly impact me. The next one came along in the 80s, the next big bust, worst recession in the post-war period in Australia's history until the most recent one. But again, I was at university studying that, and so I was more aware of the issues, the issues around inflation, stagflation, what the US Federal Reserve was trying to do in terms of squeezing inflation out of the system, supply side economics, which was a different way of thinking about economics at the time, rational expectations and so on. And so, again, I wasn't working at that time, but was very conscious of it. But these cycles sort of start to affect you after a while. You're conscious of them. They're scary when they happen. But the more you go through, you realise that you pull out the other side. And the reasons you pull out the other side were the economic system has some degree of stability to it. It's not like Karl Marx said it would just sort of spiral out of control till we had the revolution. It doesn't quite happen that way. But even if it did do that, then governments would intervene. And I think that's a good thing, that economists have devised a justification for governments to intervene when the free market goes off the rails, which it occasionally does. I'm not an Austrian economist who believes that it should be left to its own devices. It does go off the rails sometimes. But government action sort of helps stabilise it. And the most recent one is an extreme example of that. But it was probably more extreme because we got good visibility as to what was going to happen. If you tell people they have to stay at home and can't spend, and this is going to go on for weeks on end, and you've never had this before, you know that companies will lay lots of people off in mass, and therefore if you don't act, then you'll end up with something fairly horrible. So governments were able to preempt that and effectively put a cushion under the economy and freeze things in time, freeze employment relationships in time so they could bounce back coming out the other side. Likewise, the bank payment holidays, which were facilitated by easy money from the Reserve Bank. And other moves by regulators in Australia. So that's an extreme example of it, and then we've had an extreme rebound compared to the past, even though many businesses are still hurting and we're still having snap lockdowns. But the history of these things is that they have a certain pattern. You know, you get to a point where things are so good, inflation is rising, unemployment is very low, everyone's feeling happy, there's euphoria in investment markets. But central banks are getting more nervous. They think this is going over the top. They start to slam the brakes on. Initially, things keep going for a while. Most clearest example of that was 1989. They kept going for a while despite 18% interest rates. Yep. And then eventually things start to fall and you then slide into recession. Once things have unwound to a significant degree, you then get interest rate cuts, you then get fiscal stimulus, and that eventually sets the scene for a rebound. And share markets are one of the most forward-looking investment markets of all. They tend to anticipate these moves. And you can see this right through history. And each of these cycles are different. But as Mark Twain is said to have said, I don't think he actually did say it, it's a sort of a variation on some of his chapters in a book. He said that history doesn't repeat, but it rhymes. And that's what you can see through time, rhyming patterns in cycles, in economies, in share markets, in property markets. And they're the things that sensible investors take account of rather than get sucked into them. And so this affected my thinking as an investor. I was lucky in 87. I didn't have a lot of money saved up, so I wasn't a big investor, but I remember watching the share market collapse. I sort of thank my lucky stars that I didn't have an ability to go online then and take all my money out of superannuation, because I might have. Yeah. But it would have been entirely the wrong thing to do because no sooner than it bottomed, it took off again, and 88, 89 were good years in share markets. And there was a good buying opportunity after that fall. So that sort of affected my thinking going forward, such that whenever I see these events happen, I think, I should accelerate my investing when there's a downswing. This is the other thing to note. I think it's harder for investment experts to predict downturns than upswings, because a top in the market is a process that can unfold over many, many years and can be very, very slow. Whereas if you think a bottom is often deep V in shape, you come down, everyone's scared, everyone feels horrible. The fall is often very quick. The most recent example in the share market, we fell 37% in 1 month between late February 2020 and March the 23rd, 2020. So 37% in our market, US market was about 34%. So massive drawdown, but you go from being, say, a bit expensive to ultra cheap very quickly. And it's much easier to say, oh, well, we've probably hit bottom now. Sometimes you can have a bit of a double dip. You come down, have a bit of a bounce, come back and retest, and then you take off.
Yep.
But the bottoming process is a lot quicker than the topping process. And so investment experts often end up with egg on their faces trying to predict tops as opposed to bottoms. But that, to me, tells me something, that if you are an investor, particularly in shares, but also I think in property, once you see things come down and everyone get really gloomy, there's an opportunity in there that you shouldn't ignore.
Yeah.
Whereas when you're at the top, you could be saying, oh, this year's gone too far, there's too much debt, there's too much money in the share market, PE is too high. But you might find yourself the year after saying the same thing, and the year after that, and the year after that. You think about Alan Greenspan saying the words of Robert Schiller, that there is irrational exuberance. He uttered those words in 1996. And Schiller, Robert Schiller, a US economist, who I think is one of the best financial economists around, by the way.
Totally.
And he inspired me in writing my PhD with his work on variance bounds. But then by the 90s, he'd become a pop economist. There's nothing wrong with that, but that's what he'd become. Wrote a book called Irrational Exuberance. But they were getting concerned about the market for years, many years before it actually topped. It didn't top out to 2000. So you could argue, well, they're ultimately right. But if you tried to short the market in 1996, you sold it short, you would have been carted out by the time, long before the market actually peaked. There was a classic example of an Australian investor who sold his business, a petroleum business, in 1986. In anticipation of a crash in the share markets, but he used the money. He basically sold shares short, but unfortunately, the market didn't come down, and he had to buy into the market to pay back whoever he'd borrowed the shares off so he could sell them short, and made a massive amount of loss and lost a lot of his fortune. So you've got to be careful about that. I know the media love to sort of turn people who predicted the top into gurus, but oftentimes many gurus who may have got the top right usually go through a lot of pain before getting to that point. So much pain, in fact, that you could end up being wiped out financially if you took a bet on it. But bottoms are actually, I think, a little bit easy to get right, and that's why when you get these downswings, you're thinking about buying, that's a good time to do it, or edging in, dollar cost average into the market. But it certainly affected me. I almost forgot my own advice once, and I bought into a tech fund. There's a classic example. We all got sucked into these things. But I was very excited by the technology boom in the late 90s. And ultimately, I think I was right, because we're getting the benefit of all that technology now.
Totally.
But as always, the share market got ahead of itself by the time AMP, BT and Colonial First State came out with products, tech products. We're around about the top. And then, of course, I invested into one of them thinking, well, this will be all right for the long term. But then, of course, it promptly fell 80%. NASDAQ fell 80%. And it wasn't a particularly good investment. Then I thought to myself, well, all those people who bought into the Nifty 50 in 1972, which then suffered a big fall into 74, ultimately there was various studies on this. If you'd held on to your Nifty 50, Nifty 50 were the IBMs and the Gillettes and the McDonald's of the world, Avon, Kodak. If you'd held on for 20-odd years, you would have done okay. So then I thought, okay, well, I'll just keep this tech fund and it'll sit in the bottom of the drawer and ultimately be okay. But anyway, all those fund managers closed them down, so that blew that theory out of the water. But anyway.
We're sort of rounding out your own personal investment journey, but I mean, you're in the perfect seat, really. Given you've got the opportunity full time to be analysing what's happening in investment markets and its interplay with economics generally. How's that influenced you've touched on some of this already, but if we go right back to your first investment, and I'd love for you to share with us what you've invested in, why you invested in it, how's it done, and how's that leading towards the end goal for you in terms of whatever your ideal lifestyle might be. Can you sort of take us through your thinking around that and what the journey's been?
Look, I don't consider myself to be a stock picker. but I do consider myself to be an investor.
Yeah.
And I guess my first investments were putting money into St George Building Society when I was a kid, getting 10% interest. This was in the mid-'70s, and thinking I was doing fantastically well, not realising, of course, that inflation was 18% or whatever, and I was actually going backwards. But anyway, I thought I was doing well. But then as I got a career, I was lucky that I worked for a business that was into superannuation, and so I've had super before it became mandated. And that idea, I think, of regularly putting money aside, I think is a fantastic one.
Yeah.
Because it doesn't attempt to time the market, so to speak, but you're perpetually putting money into the market through time, and that money takes advantage of what I call the magic of compound interest. Actually, the guy who called it the magic of compound interest was an economist called Don Stammer, who is perhaps one of the most, for me anyway, one of the most inspiring market economists. He was well established by the time I started my career at Bain and Company, but I can remember him saying over and over, make the most of compound interest and don't get thrown off by the cycle, which I sort of have adopted almost as religion. But that has led me to a situation where I have relied heavily on my super to ultimately fund retirement. Yeah. And then I got to a point where I realised there's a limit to that. The government said there's a limit to that. So I've had to do other things, which has meant that I've set up a portfolio of mostly managed funds. Some stocks I did buy. I've had mixed experience there. I bought Qantas when it listed, and it wasn't a particularly good experience. But I guess what I've been focused on is trying to get a good broad-based exposure to the market. And this, I think, is critically important. You need to think about how much work you want to put into this. If you're going to regard this as a hobby and you can assess individual companies and come up with a system for stock picking, then well ahead, do that. Well, yeah, that's well and good. Go ahead and do that.
There aren't too many that are successful, though. If you look at all the stats,
no, there's not.
Very small percentage that endure in that regard.
It's a really hard thing to do, and every so often something comes along, the dot-com stocks and the tech boom, the day traders of the late 90s. This year, the Reddit crowd. Yep. And you think, it must be a free lunch. If only I could get into GameStop at that price and sell out at 200% profit sort of thing. They've done it. I must be able to do it too. But it's easier said than done, and for every one person who tells you how fantastic they've done, there's another 10 who haven't done so well. So that's just the mathematics of the way the market works. And so I've sort of very much adopted the approach that maybe working for AMP, I shouldn't say this, but the founder of Vanguard rules out, used to wheel out, Jack Bogle, that why spend all the time searching for the needle in the haystack, despite the haystack, get exposure to the broad market. So that's what I've done, and it's seen obviously I'm super, but it's also seen my non-super investments, which I have with my wife, rise to levels that I never imagined they would get to. So that's what I've done on that side, but also on property. I think I've been lucky there.
Lucky?
Property.
You say it's...
Yeah.
You think
well,
it's
there's a bit of luck in there, but I thought, well, I need to get involved in the property market. This was in my late 20s.
Yeah, can I ask why? Why? I'd love to delve into this question, because you're in the environment you're swimming in. You'd be surrounded in an equities environment, and that makes complete sense, because you're tapping into that information each and every day. Property not so. Yeah. What was the interest in property, and why did you invest, and what did you invest in? Can you take us through that?
Yeah. Let's go back a little bit. When I wrote my PhD thesis, there was actually a chapter on speculation in property markets, and I collected data back to the 1920s on house prices that some academics have put together, and you can sort of combine it to get a decent time series over time. Yeah. And I found that it doesn't move as much as the share market does, because it doesn't have daily pricing. That's not what I was interested in, but it does have this cycle through time.
Yeah.
You get these swings up and down.
Yeah.
And when I look at the data, it has a similar return to shares over long periods of time, but it's a good diversifier. And in fact, there was a lot of people when I started my career at AMP who I respected who said, our preferred model used to be a third, a third, a third. And this was in some of the AMP funds, a third in real assets, often property, commercial property in their case, a third in, say, fixed interest, and a third in the share market.
Yep.
So when you add it all up, you got about 2/3 in growth assets and 1/3 in what you call defensive assets. So that made good sense to me, and I also think that there's basically, it sort of fits in with this philosophy that there's actually 4 types of assets out there. There's things listed on the share market, let's call them shares, highly volatile day to day, but highly liquid, and that liquidity is good, and they pay you dividends, and I like the income flow from that. And they also relate quite closely to the economic cycle at times. Then there's real assets which relate more closely to the economic cycle because they're real. There's things like these are unlisted assets, property generally. In the case of institutional investors, commercial property, that's office, retail, industrial, and also infrastructure investments. So they're what I call real assets. They move more slowly. They're not as volatile. They're not priced in markets on a daily or minute-by-minute basis. But there's benefit in having the two. In a growth area, you want to have something listed on the share market for liquidity and the benefit that provides, but you also want to have this slow-moving thing, which is unlisted assets. And then, of course, there's cash and fixed interest or debt. So they're the 4 assets to me, but I think you should have exposure to all of them. Obviously, these days, fixed interest is less attractive because the rates of interest are so low, and you can argue the same with cash. But then again, every time we have a crisis, bonds rally, and they do provide some diversification for you. So it really depends on how averse you are in the short term. If you are risk averse, then you want to have some bonds in there. But that sort of made me think, well, I need to have properties. So I bought a investment property when I was with my wife, actually. We thought we'd eventually live in it. Didn't turn out that way because by the time we got married and decided we wanted to live in it, that we realised that wasn't the place we wanted to live in.
How long
we sold it?
How long ago was that, Shane? What sort of vintage
that
are we
was
talking?
about 1991. That was a long time ago, 30 years ago.
And that was
just
a property in the Northern Beaches?
It was in Sydney's Northern Beaches, and it had a fantastic view of Pittwater. It was like a Brady Bunch home. It was 3 levels, I think, and it had 5 bedrooms. It was a massive house. It reminded me very much of the Brady Bunch. I thought, geez, I'm going to have my Chrysler convertible, my 19-foot Chrysler convertible in there, and the station wagon will be next to that. But anyway, that didn't happen.
You don't have the 8 kids to go with it then?
Didn't have 8 kids, That's why you need those big cars. They had beautiful cars, I must admit.
Were they?
You just wanted the Brady Bunch for the cars.
You love it. I love that whole era. It was awesome. I might be testing your memory a bit, but what did you pay for the property, and if you've sold it at any stage, what did you sell it for?
We paid $299,000.
$299,000 on the Northern Beaches of Sydney for a 5-bed home.
5-bedroom home, fantastic views of Pittwater and Scotland Island. It was looked down at Scotland Island if you know the area. But it got $300 because, as I said, we couldn't afford it, so we rented it out.
Yeah, well, you're again a pioneer in the rent vesting space, doing it before anyone else had even realised it was a thing.
That's right, but it just seemed like the sensible way to do it. And then it was always full. We're always at tenants, and they're paying $300 a week. And that, to me, used to be the rule of thumb. You pay $300,000 for something, you get $300 a week in rent. It doesn't work that way anymore, but anyway.
You'd get half of that now. The yield's half of what it used to be in most
It'd be
areas.
half of that.
Yeah, that's sensational.
So now, that we sold that for $349 in late 1994.
What did you sell?
We decided we didn't want to live in that one after all, and then it was weird in a way. But then 6 months later, after I'd gotten married and my father had passed away, and I was coming to see my mother, and driving along one Saturday afternoon, I came across this open house, middle of winter in 1985, and there's a waterfront for sale, and I couldn't believe the price. I mean, how cheap it was. Because back then, waterfronts, they were popular, but not nowhere near as popular as they are now. And this was in an era before prices had taken off.
Yeah.
Like it was if you go back to the 1920s, there was a property boom in the run-up into the early 30s that got hit by the Depression and World War II. And then there was another property boom in the post-war era that ran into the 70s. There was a few blips in the late 80s and what have you. But in the great scheme of things, there's a lot of churning around into the mid-90s, and this is the time I'm buying. So I think we were at the sort of the foothills of the latest property boom. And I sort of couldn't believe how cheap this property was. And no one wanted it. It had passed in at auction. People were desperate to sell. They had bridging finance on another property. Interest rates were just starting to go up again after the early 90s recession had come to an end. And so people thought, it's back to the high interest rates of the 70s and 80s. Yeah. And it proved to be a bargain. And I still have that property. So I've always thought, I'm not heavily into property in the sense that I have a portfolio of properties, but because this one has grown to such a huge share of portfolio that it made sense to have a share of property in there and then a share of the rest in financial assets. So that's sort of where I am. Yeah, in terms of my investing.
Are you happy to share what you paid for that? And this is the property at Avalon Beach, I'm guessing that you.
Yeah, it was about 700, just over 700.
700, and
it had there was a problem once it did the inspection. There was a couple of problems. It overlapped the land reserve, the road reserve. The house was built.
Ouch.
So we had to negotiate with the council to pay a rent on that, which then worked out a present discounted value and knocked that off the price we paid for the house. And then when we did a renovation, chopped the house off, chopped the edge of the house off, which was overlapping the road reserve. I think there was another problem down the other end as well. But it's
well, you've showed me the views from the balcony in your home office there. It's a beautiful spot. Do you mind sharing us with what the property would be worth currently? You've probably got an idea.
It's hard to know. I mean, this is just luck. I know ones around here go for many multiples of that in millions, but as I say, there's a bit of luck in that I happened to buy in the foothills of what was a massive property boom that's been going on for 25 years.
Yeah, and I'm guessing if you put and I'm going to do a stab then. If you're a bit nervous too, it's probably in the 5 or 6 million mark. I would have thought, given location and what's currently happening.
No, I won't comment on that.
but I think the key thing there, you keep saying luck. I think if we refer back to some of the other comments, it's about the length of time you've held the asset.
That's critical, I think, in all of this. You have to see these investments as long term. Watching grass grow, you don't even notice that the property market is appreciated, and it's appreciated beyond levels that I would have imagined back then, just as the share market has. And you can argue, I mean, I do think it's a bit unfair that prices have gone up more than, to the point that it does make it harder for younger people to get in. And that kind of worries me a little bit, or worries me a lot, that the current generation is finding it harder to get in the property market. And we should be able to arrange things in Australia which make it fairer. But that's a judgment call. But I think if you're looking at these things objectively, which you have to as an investor, then the thing that works is compound returns rather, where returns build on top of themselves over time, and time in the market as opposed to timing.
Yeah, totally agree. I think the opportunity we have now, though, given what technology has done and what COVID's done, is shifted our. We've moved to a more decentralised model where it's much easier to live and work remotely and still be part of the global world. I think we're in the midst of a massive opportunity that's actually going to reshuffle the deck quite substantially.
Yeah,
and
I agree with that. I think that could be a factor which would make it a lot easier for people to afford good property, good locations, and good lifestyle. But it also has the effect of reinvigorating Australian regions. Of course, some of the regions might say, well, that's going to make property unaffordable in Bendigo and Orange and what have you. But for many, many years, we've seen an outflow from regional centres towards the big cities. I think this will go to reverse that. And it is actually a good thing.
Yeah.
If we manage it right, and I'm sure we can, but it's much easier to locate people in regional Australia than in the cities, which are already overcrowded.
Yeah, exactly. So I love times like this. Being of a similar vintage to you, Shane, I love times of massive change because that's where the real opportunities emerge. It's when you have a static, stable environment that it's very difficult to dig out anything in the average. We have a massive opportunity across all asset classes at the moment. If you're going in with a long-term view, I think, to really take advantage of that. Mate, I'd love to now, sort of drawing on that wealth of experience you've had both professionally and personally in looking at the economy and its effect on investment markets. And your PhD, I think, correct me if I'm wrong, but there was a fair bit of work that you've done around the sort of boom and bubble type of environment. You already mentioned Schiller's work around irrational exuberance, and I've been quoted myself on this very podcast a while back of suggesting that in certain areas, and particularly the US, there's a fair bit of irrational exuberance operating in the equities market as we speak. What's your view of, in the context of all that study you've done and all of your personal and professional experience, where are we in the cycle as you see it? And what are the risks and where might the opportunities be? And let's take a global context on this and look at it. So we're not just looking at Australia, but if we're looking more broadly, where does that sit as far as you see?
Well, in a simple cyclical context, and I'm thinking here in terms of the 4 or 5 year cycle we normally go through, I'd say we're beyond what I would call the first phase of a bull market. So the first phase is when the market is ultra cheap. We're still often in recession, but monetary policy has been eased and far-sighted investors see value in there and they push the share market up. That phase is well and truly over. We've now come into a more difficult phase. Share markets are no longer cheap. Some parts of markets are actually quite expensive. There are signs of irrational exuberance in some areas. Some commentators have referred to meme stocks as an extreme example of that exuberance. Other parts of the market still have plenty of upside. I don't think we're at the, but I think the reality is we are in that phase too. We've seen the easy gains; they're behind us. We're into a tougher phase, which requires earnings numbers to keep coming through to keep the markets going higher. And this is the case globally. I'd say the US is further advanced. The US market is further advanced in this cycle. If you look at PEs as the simplest of all valuation measures, the forward PE on US shares, this is share prices divided by earnings expected by the consensus for the next 12 months, is around 21 or 22. I know others refer to much higher numbers based on current earnings, but if you use that as a comparison and then look at Europe and what have you, it's sort of much lower. Forward PEs are much lower in Europe and other parts of the world. So I suspect that the US is perhaps at some point going to see a period of underperformance. And of course, the part of the market that's perhaps most vulnerable is those parts where there's very low earnings, the very high PEs. Tech stocks are at risk there. And they're more vulnerable as interest rates start to rise and bond yields rise. But as we've seen lately, it's going to be a slow process. I mean, a lot of excitement on that front earlier this year. We have seen some higher inflation numbers come through in the US. So far, the higher inflation looks to be in a few components associated with the pandemic. Therefore, maybe the Fed doesn't have to get too aggressive. But I think as time goes by, then it will put more pressure on those parts of the market. I don't think we're in the phase 3 yet where you see euphoria across the board. I think that's still a fair way down the track before we get to that point in the cycle. But it does, there's a lot of people out there offering different views, saying, oh, there's a crash ahead and all those sorts of things. As I said, it's often, I think it's very hard to time that.
Yeah.
I think my view is we could probably see continued gains in share markets, but you just have to allow that the pace of those gains will slow down. The easy gains are behind us. We're into a tougher part of the cycle. And you're really looking for those parts of share markets globally that have lagged, cyclical parts that will benefit from continued reopening, assuming the vaccines, of course, work. I'm assuming they will. The evidence does suggest that they help substantially in heading off illness. And unfortunate problem in Australia, of course, is that we haven't been vaccinated enough to say we're at that point yet. So that's left the authorities happy to continue to use these snap lockdowns. But providing, I think the UK is a good test case in this. If the UK, which has a much higher level of vaccination than Australia does, if they see the rise in the number of cases that they're seeing at the moment continue, but without a big pickup in deaths and hospitalisations, thanks to the vaccines, that will tell you that, yes, you can tolerate a degree of coronavirus circulating through the community without it causing big negative health outcomes. And therefore, reopening can continue. So that's the way I think things will unfold. But obviously, there's still a bit of uncertainty to get to that point. But in the meantime, I still think there's opportunities out there in cyclical parts of markets where stocks haven't fully recovered.
Yeah, and your thoughts on the property market in the same light? They're sort of parallel trajectories to some degree.
They are. The share markets fell a lot more. On average, they fell about 35% from their February 2020 high to their March 2020 low. Then, of course, they rebounded a lot faster, and we've just had the strongest rebound in the Australian share market in a financial year since 1987. I wouldn't read too much into that because we did have that fall early part of last year prior to that, which was you didn't have it in 1986, so very different comparison there. But property markets did have a bit of a dip through the pandemic, albeit it was a pretty small one. Average prices came off about 3%. In Australia, a bit worse in Melbourne. Not much in some other cities. But now we're seeing very strong gains. National property prices, according to CoreLogic, are up 13.5% over the 12 months or over the last financial year. That's the strongest gain since 2004. I think there's probably still more to go, just as I do with share markets. I think we've still got very low interest rates. There's ongoing government incentives with another 30,000 places in the first loan deposit scheme sort of programs. We've still got a degree of FOMO, or fear of missing out, running through the system, and there's a lack of stock on the market. The level of listings is pretty low. It seems as if listings picked up, but they're getting snapped up pretty quickly. So all of those things, I think, are seeing good gains in markets. I think we've probably passed the peak. Again, the easy gains are probably behind us. The rate of increase, I think, will slow down as we go into next year. Affordability is now worsening again. That makes it harder for first-home buyers to get in. Owner-occupiers, as prices go higher and higher, it gets harder for owner-occupiers to upgrade and so on. Fixed-rate mortgage rates have gone up, so the big impetus from the 2% mortgage deals is fading a little bit as those deals become harder to get. And you've also got a little bit of a drag, I think, might become more evident as long as immigration stays down, that you don't have that population growth driving prices up. So I suspect prices slow from here. prices continue to rise from here, but at a slower rate. As we go into next year. This year's going to be an incredibly strong year as a whole. We're probably looking at gains through the course of 2021 of 20%. But bear in mind, we've already seen prices go up 12%, so the bulk of that's already in the bag. Next year, I think price gains will slow down for all those reasons I just mentioned. And then if the RBA starts to raise interest rates in 2023, which is what we're assuming, then that will see a slight fall in prices in 2023. Interestingly, there's still opportunities in the property market. Units have lagged dramatically, and inner city units have also lagged dramatically in Sydney and Melbourne. So it depends on what you're into. If you want lifestyle and you want to get out into a house, then those areas aren't for you. And there are obviously issues around rents, which have been under some downwards pressure in inner city Melbourne, to a lesser degree in inner city Sydney. But you could argue that that part of the market hasn't kept up, and there may be some opportunities there. You could also argue that Perth and Darwin are still a long, long way behind, having had massive multi-year bear markets into last year, following the end of the mining boom, which ended about 2014. So those two cities are seeing catch up. And then longer term, I guess, is the renaissance of regional Australia, which is something you alluded to earlier, which I think will see regional prices generally rise relative to city prices after being out of fashion for many years. And that's going to come about because Australians say, well, look, I don't need to be in the office every day. If I do go in there, I can just go in there for a couple of days a week and put up with the traffic to do that. And so therefore it sort of makes it more possible to sort of relocate to regional centres, maybe not that far away from the cities. In some cases, people will move out altogether. But I think regional property, I suspect, has substantial upside from here. It's almost as if the pandemic, it did a lot of things. It showed us how to use technology, which we would both be using a lot more and making better use of. I must admit, before I was thinking, well, is all this stuff just useful for watching Netflix and what have you? But now you realise it actually does a lot of stuff. But anyway, the other thing the pandemic did was make us focus more on lifestyle. People question, well, why am I going to the office to do this stuff? Maybe I don't need to go in there all the time. I still want to see people, but I don't need to be in there as much. I want to see my family. I want to see my neighbours. I want to be more a part of a community. So you get this sort of refocusing of people on lifestyle, which I think will reverse what has been a 20 or 30-year trend. People coming out of the suburbs, getting closer to the cities, now pushing back out to the suburbs and then out to regional Australia, which is an interesting shift. It's almost what happened in the post-war era when everyone got a motor car. Well, roads improved.
It's similar too, I understand. I've sort of been doing a bit of reading myself on around the Spanish flu period. A big push away from the capitals back out into the regions. Didn't quite have the same infrastructure support, but very similar flavour in terms of the outlook and then the impact. You'd know more about that than I, but your comments on that?
Well, that's right. And every time we have one of these snap lockdowns, people get more inclined to think, well, geez, I better get that house out in the suburbs or the regions. This is going to continue.
What your thoughts? Let's talk about that straight away, because I think, from where I sit, and I don't have a leaning politically in any real direction, because it doesn't matter who you vote for, you end up with a politician, Shane. But I guess I've been very impressed, actually, to date, with how the recession that we decided to have, as opposed to the one that we had to have back in Keating's day, I think they've done a very good job at cushioning and riding it through. Obviously now we've fallen well back behind the rest of the world in terms of the sort of vaccination count. But I guess the continuous drop of a hat uncertainty created by these almost instant lockdowns may have an impact. What's your read on it, and what's your thoughts around what an alternative is to see us through to get back into more calm waters.
Yeah, I think Australian governments have done exceptionally well to protect Australians in a health sense over the last 12 months, but also to protect the economy. Our economy is one of the few developed country economies to actually see the level of economic activity above where it was prior to coronavirus.
Yep.
They have made mistakes. The hotel quarantine system doesn't seem to work so well. You know, we should have had quarantine further away from the cities, and of course, I sometimes think. Well, I think that we've mistreated some of our citizens overseas. If we had a better quarantine system, then we could have got more of them back quicker and wouldn't have had to say, well, if you come back from India, you'll be locked up. So there's some mistakes there. I think there was also mistakes in the vaccine rollout. I guess there was a degree of complacency in Australia that there wasn't a lot of community transmission, so we don't need to worry about it so much. We'll see what happens in the rest of the world. And then we thought, well, we can make the AstraZeneca vaccine, and it turned out to be bad luck that it had, well, at least so far anyway, more adverse or more risk associated with than the other vaccines did. So there's a bunch of factors there that could have been done better, but at least we have spent much of the last year more open than other countries around the world. They're just only starting to open up now. In terms of the snap lockdowns, I mean, this is one of those things that creates a lot of division and people have very strong views on. It's a bit like Bitcoin, either you're into it or you're not, sort of thing. And it's the same with the snap lockdowns. I guess I consider myself a pragmatic economist. I think that a healthy nation will also be a stronger nation economically, and therefore I think the lockdowns have been the right thing to do. The alternative, if you think about it, for Victoria recently or New South Wales now, is to let it run right. I mean, pray that your contact tracers have handled it, but obviously that didn't. The authorities realised that it was getting ahead of the contact tracers, and therefore if they didn't do anything, you could end up with something like happened in India or elsewhere. And we know that when you let it get out of control and you don't have a significant degree of population vaccinated, then that overwhelms the healthcare system. Look at Italy, look at New York, look at India recently, and lots more people die. And that would have not been very nice at all. It would have been horrible, and that has an adverse impact on the economy. So it's a really difficult trade-off for them, but I think they had to weigh up having a short lockdown with a known horrible impact versus the risk of having another long lockdown like Victoria had through July to October last year, with a much worse economic impact and more people dying in the process. So I think they've probably done the right thing. We've now had, prior to New South Wales, we've had 8 snap lockdowns since South Australia in November. I was in one of those in the Christmas period in Avalon. Avalon had its own cluster. Avalon in New South Wales, that is, had its own cluster. And the evidence suggests that if you implement the lockdown reasonably early, you can end it reasonably early. And I'm talking here about low numbers of cases initially, 10, 20 when you start, or less. Some of the states just do it when they've got 1 or 2. But then you can end your lockdown reasonably quickly, and therefore the economic impact is minimised. And that's been the evidence so far. Since November, since those snap lockdowns, we've been able to continue to reopen and the economy's continued to grow. So fingers crossed the same applies to the current more recent lockdowns. But I sort of think that's a better outcome than letting it run riot and letting lots of people die and then seeing people behave as if there's a lockdown on anyway. I mean, Sweden took the let it rip approach, but they ended up with the worse economic outcome than Australia did because people behave as if there's a lockdown anyway. So much as I don't like the economic impact of lockdowns, the impact on businesses I think is horrible. I don't like impinging on people's freedom, but I think there's a trade-off here, and policymakers around Australia have generally done the right thing, even though they snipe at each other and we get into these crazy debates about whether it's safe to use AstraZeneca and all that sort of stuff. Although I should just point out, the bulk of the people in the UK have used AstraZeneca as far as I can see. It was the most common one there, and it seems to have worked. So
Yeah.
Believe it or not, out of interest own bias here, I have had an AstraZeneca's jab, so I'm in that camp.
Yeah, one thing I'd sort of again like to circle back around, if I can, and again in my very limited external observation, Shane, and I certainly don't have the economic pedigree that you do. One of the sort of reads for me around changes in economies and investment markets in particular is the access to credit. And yes, we continue to be in an area where there's a lot of extra money being flushed into the system through the stimulus packages that have come through the government. We've never seen such cheap money. And as a consequence of that, we're seeing asset markets generally do very well. Do you think there'll be some intervention at some stage, and when do you think that's likely to be, and what form do you think that's likely to take? Because in my own view, that's when we're likely to see a change in direction.
Yeah, at some point the cheap money has to be reversed, and there is a reasonable concern that with all this money printing, that eventually that money gets spent, which then creates an inflation problem. So the relationship between money supply and inflation is always more complicated than I think Milton Friedman had us believe. And even though money supplies have gone up since the GFC, it hasn't necessarily led to more inflation because the velocity of circulation of money went down, and some of the increase in the money supply was sort of very narrow money. It wasn't actually money circulating in the community. So you didn't see much of an inflation response post the GFC. This time around, the risk is greater because governments are also spending more. So there is an avenue through which that increased money, that cheap money, finds its way into spending and could generate inflation, not necessarily in the short term. And I think the pickup we've seen recently in the US is more transitory, but on a 3 to 5 year view. And central banks will be aware of that, and ultimately I think that does mean at some point they'll have to start raising interest rates and taking some of that money out. At the moment they are talking about doing tapering, which is jargon for slowing the rate of money printing, basically. That's not actually taking it out. A long way to go before you get to that point, but it does tell you there is an end point here at some point. If you sort of think about the worlds that we went into in the early 80s, central banks said we've had enough of high inflation. It's led to slow economic growth. We've got higher unemployment than we should, but we've also got this high inflation. High inflation creates its own problems that people are less certain about the future. They waste a lot of time trying to protect themselves against that inflation. Companies under-allow for depreciation when they undertake their investments. Suddenly find they've got to spend a whole lot more, which means that earnings estimates are usually inflated. This gets a bit complicated, but so they push back. Starting in the US with Volcker and then Australia in the 90s, they pushed back and they squeezed inflation out of the system, and that was helped by competition reforms, deregulation, privatisation, globalisation, all of these things. Now a lot of those things are all going in reverse. Central banks are now more focused on getting inflation back up. Globalisation looks to have topped out. Tensions between Australia and the US and other countries and China. And so you could argue that some of the pressures that gave us low inflation are starting to reverse. As that occurs, it could create some problems for investment markets at some point, but the main issue will come when central banks start to raise interest rates. At this stage, I'd say that's still a few years away. The optimist in me says, well, don't worry about it too much, because central banks know that people also have more debt than they used to have, and therefore they won't raise interest rates automatically by big amounts. They will just, if the Reserve Bank, for example, decides inflation is going to be a problem, they'll start raising interest rates, but they will do it very gradually. A 0.25% move, wait 3 months, see what happens. They would be aware that the level of debt to income these days for an average household is 4 times what it was in 1989. So therefore, an interest rate hike today of 0.25% is equivalent to a 1% interest rate hike in 1989. So they will be more cautious in raising rates. But you just have to allow that at some point there will be some reversal, and central banks will become a bit tighter.
Yeah, do you think, because what we've seen in recent years is a much heavier reliance on other macroprudential measures by changing bank policy and access to credit as a way of calming and influencing the market rather than toying with rates. And given that both the government and the sort of general debt level amongst a lot of the population is high, as you say, do you think from your read that they're more or less likely to use those sort of macroprudential measures than rate rises to achieve exactly the same thing?
I think that's right. The macroprudential controls will come earlier, or come first, and then eventually it'll be the interest rate hikes. So,
yeah.
I guess you could look at New Zealand. The Reserve Bank there has already tightened up some macroprudential controls about lending to investors, and loan to valuation ratios, and so on. In the absence of being able to raise interest rates, or absence of being or wanting to raise interest rates. So I think we'll probably see the same thing in Australia, that APRA and the Reserve Bank, or APRA working with the Reserve Bank, will move to tighten lending standards probably sometime in the next 6 months or the next few months. They'll move down that path. We've seen housing credit growth it's now growing at an annualised rate of 7%. To get the annualised number, I'm taking the monthly rate and multiplying it by 12, which is a bit of a distortion. The 12-month ended number is still well below that, but it is heading up. And the reason I noticed the 7% number there is when I look at it, that was the level they started to tighten macroprudential controls in late 2014. A few years back in the previous cycle. So I suspect they will go down that path first, because their argument will be, well, housing has become very hot. We are getting a bit concerned about the rate of growth in housing-related debt, so therefore we want to slow it down, but we don't want to snuff out the sort of tentative recovery we're seeing in business investment.
Exactly.
And so therefore they go down the macroprudential path first, and then eventually, once the rest of the economy is stronger, they start to raise rates, which is, they have been saying for some time they don't expect to raise interest rates, or don't expect the conditions for a rate hike to be in place till 2014. I think that could come a little bit earlier though, 2014. It could come a little bit earlier. We're forecasting 2023, but it's probably still a couple of years away before they do that.
And I think the good thing is now, with one of the positive sides of the fact that we're in such a instantly connected 24/7 world, is that even the signalling of those things by the likes of yourselves and others can actually have an impact on the market, as you said earlier in our discussion today, that may actually temper market activity without the need to physically pull the lever. So
that's actually quite possible. We have already seen, I think some of the banks have already tightened up their lending criteria.
They have.
I think
we've got a broking license with our business, and we've already seen a couple of the majors that are now coming down hardline on debt to income ratios. And instant declines with a couple of banks for if the DTI is more than 6, then that's an automatic decline. There's been a little bit of an easing on living expenses, but there was a real focus on living expenses some time back. That's had an impact on it. Some of the banks are shading how much income they'll take from rental and other sources. So we are starting to see some of that happening already, purely because I think some of the banks are doing so much volume that they actually can't cope. And they're instituting some of these things to slow things down a bit themselves.
Slow down, yeah.
Yep.
You may recall in the last cycle, the APRA put in place a lot of quantitative macroprudential controls.
Yeah.
And then they withdrew them, and they said basically they'd moved across to qualitative, and they expect the banks to maintain reasonable lending standards. So to some degree, you could argue, well, the banks may have learnt from that, and therefore they'd rather tighten up before having quantitative constraints put on them. So, it could well be the case that APRA just has to wave a wand and write a letter to them, as they have recently, telling banks to maintain their standards, that it has the desired impact without having to do something. That's quite possible.
Yeah, no, that's good. Okay, so I just sort of bring that to a head then, I guess. If I want to look at this in three different scenarios. If you are interested in your approach to investing, then if you are just starting out, if you're someone who's in your sort of late 30s to mid 40s, and someone who's about 10 years away from retiring, what generically, and again, this is not financial advice, but generically, given the context of the environment that we're in and that we're likely to be in, where would you be investing now if you're in each of those positions?
Well, if I was just starting out, I'd be putting money aside regularly. I would probably want to get some exposure to property. I would, if I'm just starting out, I may not have much to put aside for a deposit, but if I can, I'd look for something which is affordable, maybe regional Australia, where you're getting good rental income and the prospects of stronger long-term demand as people relocate to regional Australia. But I would also be looking, perhaps through super, to put money aside regularly into share markets. And I'd be focused here on a longer-term view, not short-term. So I'd probably take a relatively high-risk exposure to that aggressive approach. Like if you're thinking about your super, and I'm not speaking to anyone in particular, this is just general advice, the younger you are, the more you can withstand volatility in the market. So therefore it makes sense to tick the aggressive box on the super fund. Just allow that, you might have a few drawdowns, but when you're young you can withstand that, and you'll still have your salary going into the market when it's fallen to those cheaper levels. If you're in the middle, I don't know that I would diverge from that dramatically. In the middle, you probably want to have the family home somewhere in there. And I would still see that as part of your investment portfolio, even though you're living in it. So the focus shifts from buying something as an investment to buying something that you want to live in, and hopefully that investment you undertook when you're in your 20s or early 30s perhaps will then can be sold and then enabled you to use as a deposit for your the house you then live in. The property you live in. But I'd still maintain a fairly aggressive approach to investing to make the most of compounding and long-term returns you get out of share markets. And then as you get closer to retirement, it really depends on your wealth. If you've got a very high level of wealth and you've got a high risk tolerance, then you can probably stay aggressive because you can withstand drawdowns. But a lot of Australians don't have a massive level of wealth and they're more constrained, and therefore it does make sense to become a little bit more conservative as you get closer to retirement. Very
well summed up there. Just before I jump into the ambush round, I'd love your take on the crypto craze, because let's face it, it's like the new gold rush, or it has been in recent times. And I won't colour the picture with my views on it, but I'd love your thoughts around the investment value of crypto. But let's put aside its utility. From an investment perspective, where does it fit as you see it?
This is an interesting one because it creates so much excitement, and some people are committed to crypto and Bitcoin, particularly almost religiously. And if anyone says anything against it, they get pummeled. And I recently participated in a debate on this in the ABC, and I found, you can get overwhelmed with this stuff. But the way I see it, I mean, most people that say crypto, you think of Bitcoin, it's the main one I guess the first question to me is it going to become a currency? Is it just the early stages of something which will become a currency? And therefore there's an argument to back it for those reasons. And I must admit I'm a bit sceptical on that front, because it's very volatile, as we've seen.
Yeah.
It goes up and down and all over the place, whereas I want a currency to be relatively stable, and know that if I've got some money in my account, that it'll buy a certain amount.
Yeah.
But not bounce around all over the place like Bitcoin does. Secondly, it's very slow. I know there's a thing called the Lightning Network, which is trying to work on speeding it up, but that doesn't seem to have happened. So you can't put it down on a reader in a retail shop and tap and go sort of thing. It's tap and wait 10 minutes sort of thing to do it. And the average transaction when I last looked was running at about $30 a transaction. So for all those reasons, I don't see it becoming a common currency. Some governments might adopt it for reasons of their own, such as El Salvador, which is Keating's Banana Republic, uses the US dollar, gets the equivalent of 40% of its GDP from its citizens which live in other countries, mainly the US, sending that money back to El Salvador. So it makes sense for them to use Bitcoin because it's cheaper to do those international transactions than it is to go through a bank where the fees are much higher. So I think that the specific reasons as to why some countries will adopt it, but most countries won't. They will prefer to keep their own currencies. They know their citizens have greater trust in their own currencies, whether it's US dollars, Australian dollars, renminbi, whatever. And those governments are under increasing pressure to regulate it because they know it's extremely volatile, and some people are thinking there's a free lunch in it. And if it falls apart, then they might have to pick up the pieces. So there's more regulation coming the way of Bitcoin. But I think if it's not going to be a currency, Bitcoin, then the question is, what is it? It's not a property that generates rent. It's not a share that generates earnings. So therefore, I can't value it. So therefore, as an investor, it's worth whatever you think it's going to be worth. It's just
exactly.
You can dream up any number you want.
The greater fool approach.
It's really just a vehicle to speculate in. And I know people say, well, it's come from nothing to $65,000 or $35,000, whatever the current price is. That just proves that it's not a bubble. Because it's been around for 13 years now, and it's gone up a lot. But I don't think that proves anything. It just proves that people have got excited about it. And there's two groups of people who get excited about it. Tech. People are really into technology, and people who are libertarians don't believe government should run currencies. And if you combine those two things, then they get really excited about it. But for those reasons, I think one should be a little bit sceptical as an investor in it. That said, this is not to deny that I think there's incredible value in the concept of the blockchain, and some of those cryptos out there will end up having a use probably in government-run currencies. And I did note that the RBA is looking in a digital currency, a central bank digital currency, using an Ethereum or Ether platform. So it may end up being used for something else, but not necessarily Bitcoin. And I think when I last looked, there's almost 10,000 of them. There's a lot of them anyway. So if you're telling me it's Bitcoin, but why Bitcoin and not Dogecoin, Dogecoin or something else? Could be any of them. You just don't know. So it's an interesting area, but I think you should really. I like to invest in things I understand, and where I can assign a certain value to it, and I struggle a little bit with it. I mean, I sort of wonder why the average Australian would go for it as a currency when you can load your bank account or whatever it is on your phone, instantly do transactions. If you arrange your fares in a certain way, you can do those transactions so that they have zero cost to you. Put every transaction you have through your credit card, always pay it off by the due date, and collect the points that it pays. That covers the credit card fee multiple times. So it's free money to me. And that doesn't answer the question of international transactions, where it may be cheaper to use Bitcoin, but most people don't do a lot of international transactions. And I reckon the banks are going to be under a massive competitive pressure to get the cost of those international transactions down anyway. So, I don't think Bitcoin will be it for that.
It's funny, Shane. This is a couple of years ago now. I tongue-in-cheek did a Facebook Live announcing the release of Bushcoin and what it was going to do for property, and it was totally tongue-in-cheek, and I was buried with inquiry. I
Really?
couldn't believe that people were taking it seriously, and it just told me that whole gold rush, instant, overnight shininess of anything these days, people seem to be happy to throw money at it versus what we talked about earlier, watching paint dry or grass grow, which is what, good sustainable investment's all about, just doesn't seem to get the same limelight. So
it's the world we've come into is all about excitement. And it's the way we get our media these days. You don't look at a boring newspaper with some stuff on the front, which gets you into it, and the rest is all pretty boring. But it's all about entertainment, and unfortunately, bits of the investing world have gone down the same path. But the rules of investing haven't changed one iota. To me, it's still about only investing in things you understand, that making sure there's good value in it, that it generates income over time, that you invest for the long term, that, as we just mentioned, it should be boring as watching paint dry or grass grow. But unfortunately, every so often we get distracted from that, and we think there's instant riches and free lunch, and there's an element of that today.
Yeah, what do we say? The great quote that the only thing we learn from history is that we don't learn from history, I think, Shane.
That's right.
Now I just want to segue straight into the old bushfire lightning round, which is just 5 quick questions that the listeners always want to glean your words of wisdom on. First of those, mate, is what's your favourite quote and why?
Well, my favourite quote is, "History doesn't repeat, but it rhymes." And that applies to investment cycles in particular. Each one may be slightly different. The latest one's been associated with the pandemic, but they invariably follow a similar pattern.
Yeah, absolutely spot on. That's a good one. What about a top book you'd recommend the listeners have a read of?
Look, I'm almost tempted to refer to Benjamin Graham's book on value investing.
Yeah.
And perhaps it is a better one, but I'm actually going to refer to Charles Kittelberger's book called Manias, Panics and Crashes. That gives you a good understanding of the history of manias, panics and crashes, and it lets you know that these things are quite normal in investment markets, and often out of them comes opportunity.
Yes,
which is where I guess Ben Graham and Warren Buffett have taken advantage of over many years.
Yeah, it's spot on. I haven't actually read that one, so I'm going to add that to the Kindle list as we speak, Shane. Shane, most Australians believe they pay too much tax. So just to share your thoughts around this, what's the top legal thing that you've done to minimise the tax that you pay?
Well, invest. Invest. It's quite simple, actually. I often get a debate as to whether I'm negatively gearing or not, and then I find, the interest bill is so low these days that it's very hard to negatively
Exactly. You'd be struggling with negatively
weird. But yeah, invest. A basic principle of our tax system is that if you undertake investment, the cost of doing that investment can be deducted against your income, which I think is a fairly sensible thing.
Yep.
And is why, believe it or not, I'm not actually in favour of removing negative gearing for property.
Yep.
I mean, there is an argument to look at the capital gains tax discount, but I'm not in, because that is, you could argue, is a bit of distortion in that. But negative gearing, I don't think, is a distortion. I mean, some people may take it to an extreme. We have 20 or 30 properties out there, or 10 or whatever.
Very few of those.
There's very few of those, but I think most people make sensible use of it, and it is just a basic principle of our tax system that you invest and you can deduct the cost of that investing against your income. So that's something that I've done.
Yeah, and particularly when governments aren't, the days of housing trust and public housing are long gone, and we've still got fairly strong and ongoing housing shortages in many areas. Well, it's a good way to incentivise mums and dads to be sticking money into bricks and mortar. That's also satisfying the housing need. But I digress. That's there. Right. Back on the investment, and you've covered some of this already, but I'd love you to share with us quickly the worst and the best piece of investment advice that you've ever received today.
The worst, I was probably around investing in tech, although I was carried up with enthusiasm for that. The best, believe it or not, we're going to come back to Don Stammer. Make the most of compound interest and beware the cycle.
Yeah. It's
and I kept repeating that one over and over, because if you do those two things, make the most of compound interest, you've obviously got to invest in growth assets to do that, but just don't get blown off every time there's a cyclical downturn.
Yeah, but gems like that aren't sexy, but they're very profound if you heed the patience and persistence needed to actually see those through. What about a personal habit that has contributed most to your investment success today?
Look, I'm a relatively stable and habit-prone person, which has led to the habit of regularly investing, putting money aside. Yeah. So that, to me, is perhaps the best one that's contributed to my success. I love this idea of averaging into the market, not claiming I'm going to time it. But regularly putting money aside to go into the market. I mean, to some degree, we're lucky in Australia because we're forced into that via our superannuation arrangements, and lots of other people don't have that. But it's a brilliant thing in a way. It's sort of, financial planners talk about dollar cost averaging, but it is effectively dollar cost averaging. Yep. But in recent times, I've sort of tried to augment it a little bit, and if I've got some money sitting around in cash, and markets have fallen, then you try and do a bit more.
Yeah, exactly. Yep, it's simple but extremely effective. Final question to bring it all to sort of a neat summary then, Shane. If I gave you a microphone that spoke to every single one of the approximately 7.7 billion people that are currently alive in the world, and I gave you 1 minute to talk, what would you say?
It would be something like along the lines of this, which is really just an amalgam of my favourite sayings regarding investing. The first thing to do is you have to make the most of compound interest. Now, this sounds very boring, but history tells us that growth assets will provide good returns over time, and those returns will grow on top of each other. To do that, you have to invest for the long term. You have to focus on things you understand. If something comes along, whether it's .com stocks or Bitcoin or whatever, and you don't understand it, you're better off staying away. But once you've got this going, make sure you don't get blown off the cycle by cyclical downswing, for example, or alternatively, don't go piling in and gearing up just because there's a cyclical upswing. Stick to a longer term approach. But I think one of the most important things to achieve successful investment over time is to turn down the noise. We've gone from a situation decades ago where information regarding investments was hard to get, and this is paraphrasing, I think his name was Peter Lynch, who was a Fidelity investor, to now have a situation where it's hard to get away from all this information. But the trouble is, all that information, some of it directly relating to investment, some of it not, distracts us dramatically. And history and psychology shows that if we get too distracted, we become uncertain and we make lower quality investment decisions. So it's critically important to turn down the noise. Yeah,
or worse still, do nothing. You get paralysed.
Well, the do nothing option is once you're exposed to conflicting information, which you can these days, it's quite easy via the media. As we're bombarded by this stuff, you end up paralysed. Yeah. And you do nothing. Your money just sits in a bank account earning 0.5%.
Yeah, and going backwards when inflation's thrown in. A beautiful way, actually, to bring that to close, Shane. You've been extremely generous with your time and your insights again today. And if we're looking to turn down the noise and focus on information that is going to be relevant to making good quality decisions, I can say from personal experience that your insights are going to help the listeners in doing that. If they want to glean more of your wisdom on a regular basis, what's the best way for them to do that, Shane?
Look, the simplest way is to follow me on Twitter, where the handle is @ShaneOliverAMP. I do write regular weekly reports. I know a lot of people on Twitter just want the 280 characters, but I do have links in there to all the reports I put out. There's one I put out usually once a week, but not always, called Oliver's Insights, and there's also a regular weekly report I put out on Fridays, and those are on the Twitter account. So that's probably the best way to get access to my insights.
Love it. No, Shane, you've been extremely generous as usual. Always love the sort of objective and transparent way which you embrace the entire situation without prejudice. So I want to thank you very much for dedicating the time today.
Thanks, Bushy, and it's been a pleasure to be on the program, and I hope that's some value for everyone who's listening to it. And just finally, I look forward to investing in Bushcoin once you get that up and going. Well, that looks like you probably won't.
I'll send you the prospectus there, Shane. Thanks for your time, mate. Look forward to talking soon.
That'd be good.
Thanks,
Thank
Shane.
you.
Cheers. Get a summary of all this investment gold in the show notes. Just email me on hello@khgroup.com.au. It's HELLO@khgroup.com.au. Or check us out at www.bushymartin.com.au/Get Invested. I look forward to joining you next week for another episode of the Get Invested podcast. So thanks for listening, and as always, dream as if you'll live forever and live as if you'll die